Today we're going to break down what's happening with auto parts maker PPAP Automotive. Their latest quarterly results just came out, and, well, they tell a pretty fascinating story of some big challenges, but also a really interesting strategy. So, let's get right into the earnings call and see what's really going on under the hood.
So, right off the bat, here's the headline number everyone's talking about, a 4.9% drop in revenue from this time last year. Now, a number like that, it definitely makes you sit up and pay attention. It kind of sets the stage for a tough year ahead. So the question is, what's behind this?
And yeah, that leads us right to the big question, doesn't it? Is PPAP actually in some kind of trouble? Look, a drop in sales is never what you want to see. But the real story is almost never in just one number. We're going to unpack everything, their performance, the market they're in, and their game plan to figure that out.
Okay, so first things first, let's zoom out and look at the bigger picture. PPAP's rough quarter didn't just happen out of nowhere. You got to remember, as a company that makes parts for cars, their success is totally hooked to the health of the entire auto industry.
And this right here tells you so much. The company's revenue was down 4.9%, right? But check this out. The entire Indian auto industry fell by 5.1%. So they were actually performing a tiny bit better than the market as a whole. They were swimming against a seriously strong current, and understanding that context is absolutely key.
And here's where you can see exactly where that industry pain was coming from. Passenger cars, which are a big deal for PPAP, were down about 1.5%. But the real gut punch, that came from two-wheelers, which just cratered by more than 6%. When you supply parts to all these different vehicle types, a slump this widespread is something you just can't escape.
All right, so we know the whole industry was having a tough time. But what were the specific things that hit PPAP's bottom line? Let's pop the hood and figure out why their own engine kind of stalled out this quarter.
You know, the earnings call made it crystal clear. It was basically a 1-2 punch. First, you had the big problem of just weak demand across the board, which we just talked about. But then they got hit with a second problem, something specific to them. Some of their biggest customers delayed the launch of new car models. That means the orders they were totally counting on for Q1, well, they just didn't happen.
And here's what that actually looks like in the real world. Their factories were only running at 62% of what they could be. Think about that. Almost 40% of their manufacturing power was just sitting idle. That's a huge deal because you still have to pay to keep the lights on, so it's a massive drag on your operations.
Now, this is a really important point. You might think, okay, maybe their costs went up, right? Supply chain problems, raw materials. Nope. The CEO, Abhishek Jain, was super clear on the call. He said their supply chain was fine and material prices were actually stable. Some even went down. The problem was simple. Profits were squeezed because they just weren't selling enough stuff. It was a demand problem, plain and simple.
Okay, so that's the bad news. But, a tough quarter is one thing. Having a plan to fight back is another. And this is where the story really starts to shift. Despite all those problems, the company's leadership sounds surprisingly optimistic. So let's get into their comeback plan.
And this number right here, this is the hero number of the whole story. 3,439 crore rupees. That is the total value of their confirmed orders for the next few years. We're talking signed, sealed, delivered deals. This one number gives them incredible visibility into their future sales. And it's the rock-solid foundation of all their confidence. It tells you that even with one slow quarter, long-term demand is looking really strong.
And here's that confidence coming straight from the top. The CEO, Abhishek Jain, was asked point blank if they could still hit their full-year revenue target after such a slow start, and he didn't hesitate. He basically said, yep, we're on track. And for a CEO to say that on a public call, that's a big commitment. It shows they really believe in the pipeline they're seeing.
So why are they so confident? Well, it really boils down to 3 key things. First, remember those customer projects that got delayed? Well, they're about to kick off. So that revenue is going to start rolling in. Second, the CEO mentioned that sales were already looking better in July and August. And third, and this is maybe the most important, the new business they're winning is in the hottest parts of the market, SUVs and EVs.
But their game plan isn't just about winning more business in the auto sector. A huge part of their long-term strategy is to not have all their eggs in that one, very cyclical automotive basket. They're actually building out a bunch of new businesses to make the whole company stronger and more resilient.
This chart gives you a really good snapshot of what that looks like. Of course, you've got the main automotive parts business. That's still the core.
But then you see these other pieces, an aftermarket parts business called Elpis, a high-precision tool-making business called Meraki, and then this whole bucket of new ventures called Avinya. The goal is for each of these to grow into its own powerful engine.
And get this, these aren't just little side hustles. They are delivering some serious growth. So while the main auto business was down, their aftermarket division grew by 27%. The toolroom's order book jumped 30%, and they think their industrial products division is going to double in sales this year. This is what that diversification plan looks like in action. And you know what? It's working.
Now, inside those new ventures, there's one story in particular we need to zoom in on because it's so important to their future. For a little while now, their battery division has been, well, a bit of a problem, but they've made a really big strategic change to try and fix it for good.
And here it is, the pivot, plain and simple. They're getting out of the business of making batteries for things like electric scooters. It's a super crowded market, a real dogfight. Instead, they're shifting their focus entirely to energy storage solutions. Think big battery packs for homes or businesses. It's a totally different game, and they believe it's a much smarter path to making that division profitable.
All right, so let's wrap this all up. We've seen the tough market, the internal hurdles, but we've also seen a really clear plan for a comeback, plus a long-term growth strategy. So what does the road ahead actually look like for these guys?
This table really sums up the whole story, this kind of tug of war. On one side, you've got some very real risks. The auto industry could stay sluggish, there's some uncertainty about export tariffs, and finding enough rare earth magnets for EVs could be a challenge. But on the other side of the rope, the reasons for optimism are just as strong. That monster order book, real growth from their new businesses, and being perfectly positioned for the rise of EVs and SUVs.
Which leaves us with this final, crucial question. PPA Automotive is sailing into what looks like a pretty serious industry storm, but they're holding a really strong hand with that massive order book, and they're growing new businesses. So, the big question for the next year is, will that hand be strong enough to see them through the storm? That's the story we'll be watching. Thanks so much for joining me.